Let AI take care of the job of earning money.
Hi everyone, welcome to this video. Today, we're kicking off a series on trading indicators. This series is made for beginners, those who are just starting out in trading or feel like they only know a little about it. Think of these videos as your foundation, something to help you ease into the world of AI trading. But I'll be upfront, this isn't where you'll find some magical strategy that'll make you rich overnight. If you're looking for a one-size-fits-all holy grail, well, there are other channels for that. In this video, we're diving into MACD. You've probably heard the name, it stands for Moving Average Convergence Divergence. It's a classic tool for analyzing the strength of a trend. What it does is look at how two lines interact, are they crossing, diverging, or converging? That tells us how strong or weak the trend is. But let me make this super clear, MACD does not predict where the market is going. All it does is measure the strength of the current trend. So, what's MACD made of? It's built on three parts: the MACD line, which is also called the fast line, the signal line, also known as the slow line, and the histogram. The default settings use three EMAs, 12, 26, and 9. The MACD line is just EMA 12 minus EMA 26, and the signal line is a 9-period EMA of the MACD line. If you're not familiar with EMAs yet, no problem, we've got a video covering moving averages, so feel free to check that out. Now, depending on the platform you're using, you might see the MACD line called DIF, and the signal line labeled DEA. The histogram? That's just the difference between the two lines, and it's often displayed in red and green to make it easier to spot whether the MACD is above or below the signal line. The good news is, your trading platform will do all the calculations and plot everything for you, so don't waste time on the math. Focus instead on how to interpret it. Here's how MACD is commonly used. First, you've got golden crosses and death crosses. A golden cross happens when the MACD line crosses above the signal line, which is usually seen as a buy signal. A death cross, on the other hand, is when the MACD line crosses below the signal line, signaling a sell. These are great for spotting changes in trend strength. Second, there's the histogram. It's not just a visual, it tells you about the difference between the MACD and signal lines and helps you see whether buyers or sellers are gaining momentum. If the histogram flips from red to green, buyers are getting stronger. If it flips from green to red, sellers are taking over. Third, you've got divergence. If prices are making new highs but MACD isn't, or if prices are hitting new lows but MACD doesn't follow, that's a sign the trend might reverse soon. MACD has its strengths and weaknesses. It's a fantastic indicator for trending markets, but it doesn't perform as well in sideways or choppy conditions. So, before relying on it, make sure you're not in a range-bound market. Alright, let's talk testing. We put MACD to work on Bitcoin. We tested 20,000 candles, focusing only on long trades. The risk-to-reward ratio was set at 1.2 to 1, and we allowed up to 10 open positions at the same time. This means that whenever a new signal appeared, we'd enter again, even if previous trades were still running. Now, in real trading, letting 10 positions run at once might not suit everyone. Personally, I prefer to cap it at 2 or 3, but hey, that's just me. It all depends on your risk tolerance. We also tested MACD under different conditions: pure golden crosses below the zero line, and combining MACD with other indicators like the Vegas tunnel. The results were interesting. We found that combining MACD with another indicator significantly improved performance. It's a good example of how the right combo can give you better results. That said, MACD still struggles in sideways markets, like most indicators. So, let's talk about divergence. For this, we're referencing a strategy by the crypto guru Ban Mu Xia. His strategy is pretty famous because it's simple and easy to understand. Later, I'll also share my thoughts on it. In real trading, a lot of people don't actually use the default EMA settings for MACD. Instead, they swap them out for Fibonacci-based EMAs, like EMA 13 and EMA 34, to replace the default EMA 12 and EMA 26. What's Fibonacci? Don't worry, we'll make a video about it later to explain. Now, if you've done strategy testing before, you probably know this: different testing conditions will always give you different results. For example, just changing your take profit and stop loss levels can significantly impact your backtesting outcomes. The tests I ran on August 1st might not match the ones you do on October 10th. Your win rate and profitability are bound to differ because market conditions are constantly changing. So, don't stress if your results don't exactly match mine. For example, if I tested a win rate of 55% and you got 52%, that's completely normal and within a reasonable range. But if I'm getting 55% and you're down at 40%, then yeah, something is definitely off. Either my test or yours has an issue. Alright, let's jump into the testing results for different scenarios. We started with the basics, testing golden crosses across multiple time frames, 5-minute, 15-minute, 30-minute, 1-hour, and 4-hour charts. The results? There's no evidence to suggest that MACD performs better just because you're using a longer time frame. Based on my tests, the 15-minute and 30-minute intervals performed best. In fact, for crypto or forex traders, 15 minutes is one of the most popular time frames to use with MACD. Next, we filtered the golden crosses to only include those happening below the zero line. Testing across all the same time frames, we found that adding this filter didn't significantly impact the results. Now, some of you might remember from another video where we talked about the Vegas tunnel. By itself, the Vegas tunnel doesn't perform that well. But what happens if we combine it with MACD? Well, here's where the magic happens. Testing different time frames, we saw a huge improvement in performance when using both indicators together. It's a clear example of how combining tools can lead to better results. After that, we tested how market conditions, like consolidation, affect max win rate. For this, we focused on the 15-minute time frame and looked at 3 scenarios, when the previous price range was 1%, 3%, and 5%. The results showed that the bigger the price swings before entry, the better MACD performed overall. This aligns with the idea that MACD shines in trending markets and struggles in sideways ones. Finally, we tested MACD divergence. This is where Half-Summer Xia's strategy comes in. His idea is straightforward. When the MACD histogram shows weakening red bars while prices are hitting new lows, that's a divergence. This signals it's time to go long. We quickly coded this strategy using ChatGPT, added a few filters to reduce noise, and set our stop loss and take profit levels at 2.5 times ATR. ATR, by the way, is a great tool for setting stop loss and take profit levels, and we'll make a video on it in the future. So, how did the strategy perform? Pretty well, actually. But here's my take: it's great as a secondary or backup strategy but not ideal as your main one. Why? Because the number of trades is too low. Even though the win rate is high, you might only get 18 trades over 2 years. That's just not enough if you're looking for consistent passive income. To hit that sweet spot for steady income, you'd need at least 20 trades per month with a win rate of around 70%. Looking at Half-Summer Xia's trading records, his big profits were concentrated in one short period. Before and after that, the performance didn't seem as impressive. This tells us that while the strategy worked well for that specific market condition, it's not something you can easily replicate across all market environments. So, what are the key takeaways? First, MACD divergence is a fantastic area to explore. Because MACD focuses on trend strength, combining it with price action can give you a great edge in spotting reversals. Second, combining MACD with other indicators usually produces better results. And third, avoid using MACD in range-bound markets, it's just not built for that. Honestly, this applies to most indicators. In conclusion, MACD is a great tool for AI-driven strategies. It won't make you a millionaire overnight, but it can be a solid ally in your trading journey. If you found this video helpful, don't forget to like, subscribe, and share it with your friends. Got questions? Drop them in the comments below. Thanks for watching, and I'll see you in the next one.